Okay, good morning, everybody. Welcome back. Today's Wednesday. We're still working in chapter 4 today. We should get through the slides today, and then my plan is on Friday to go through some of the examples of the journal entries that are actually within the chapter from within the text. I think that would help give us a little more understanding of some of the entries that we expect to see on both the internal service, or I'm sorry, special revenue fund and the general fund, because those are two we're working on in this chapter. So on Monday, we left off with the modified accrual expenditure cycle. I know this is something we've already touched on a few times in this class. I just want to just go ahead and start and just run through it one more time today before we move on to the next topic. So right here we can see obviously the supplies are ordered at an estimated cost of $3,500. So we know whenever we place an order for supplies, what do we have to do? We encumber those funds to make sure that we don't overspend. So we know that entry is going to be a debit to encumbrances for the relative amount, which in this case is $3,500. And then the offsetting entry is the credit to the budgetary fund balance reserved for encumbrances. Now we've got the funds encumbered once the order's in place. Then we know once the supplies are going to be received with the actual cost, we first have to unencumber the funds. If all the supplies come in, we unencumber all of them, right? If it's only a portion of them, then we only unencumber the portion that was received, right? So we can see here the third entry down. Because remember, I like to reverse it first. Like I said, it's up to your choice, but I just like to reverse it to make sure we don't forget to do that step. So we can see here under the second entry under received goods, there we've reversed that regular and or the original encumbrance entry. So we now debited the budgetary fund balance reserved for encumbrances and then credit encumbrances. So now we're back to square one, right? But now we do actually we do have the goods or service, or we've received the goods here. So now we do have a liability, right? So now we have to set up the liability or set up the payable or pay them, right? Well, in this case, the first thing they did was set up the liability. So now we actually incur the expenditure, right? So we debit the expenditure for the actual amount, right? In this case, it's $3,250 because of the cost of $3,000 plus shipping of $250. So debit expenditures $3,250, credit accounts payable $3,250, and then obviously, once payments remitted to the vendor, we debit accounts payable and credit cash. And why again on payment? Why do we debit accounts payable and credit cash? What justifies us making that entry?
That's us paying off a liability.
Right. And we know that accounts payable is an original credit on original entry. So in order to reduce that liability, which we are because we're paying it, we have to debit it, right? And then cash is an original. It's an asset. So obviously, if we're crediting it, then we're reducing it because money's going out the door. So there's that. So there's the modified accrual expenditure cycle. I think we're probably getting familiar now. Now it's becoming more just routine now, right? It's something that we're used to seeing now. So we encumber the funds when we order the goods. We unencumber them once the goods are received, and then set up the liability, and then we ultimately pay the liability from there. Not bad, right? Okay, short-term borrowing. So a lot of times governments they'll have like payrolls and just current expenditures or current expenses that are due, but they're a little short on cash, right? Because maybe they haven't collected all the property taxes that they've levied, or whatever it might be. They just have a little bit of shortfall on some cash flows. So the governments a lot of times will go into short-term borrowing with local banks. Like say for example, the city of Bluefield has some payrolls that they need to get out the door, and they don't have the money or the financing available for it. So what they'll do is they'll go to a bank and actually take out a short-term tax anticipation note. And what that is pretty much is just telling the bank, hey, we've got these taxes coming in, and we just need a short-term note. So it's just known as a short-term tax anticipation note. And it says here, since governmental funds recognize obligations requiring current financial resources to settle current borrowings, or I'm sorry, let me start over. Since governmental funds recognize obligations requiring current financial resources to settle, current borrowings are going to be recorded in the same manner as commercial businesses because it's a current borrowing. So we know it's not a long-term debt, right? It's current. So we are going to actually account for this debt within the governmental funds because we know most long-term debt or long-term debt, long-term liabilities, where is that going to be reported within the governmental statements?
Long-term debt, would that be in the budget? No.
Remember, because think about the focus of accounting that we're using on governmental funds. It's the what type of focus? Current financial resource measurement focus, right? The modified accrual, meaning only current stuff is what we're concerned about within those things. So therefore, anything long term in terms of governmental funds is in the government wide statements. Remember, because they're on the accrual basis. So anything long term or any capital assets is going to be on the government wide ones, not within the governmental funds. And why is that again?
Because they're on the accrual.
The modified accrual, or the government wide on the accrual, and the governmental is on the modified, and they're only so governmental funds are only concerned with current resources and current expenditures, right? So that's why the short-term tax anticipation notes are recorded within the governmental fund. So what's the entry look like when we actually receive this short-term tax anticipation note? Obviously, we're receiving cash from the bank, right? So we know cash is original asset. So it's going to be an assets or debits on the original entry, right? So we're going to debit cash for $250,000, and then we're going to credit the tax anticipation note payable for $250 because we know that's a liability, right? So that liability is increasing with the credit there of $250. Banks usually don't have an issue with dealing with governments like this, with doing these short-term tax anticipation notes, because they know that they're going to get their money back. Chances are because of the government having the ability to levy tax, the power to levy taxes. So this is something we see pretty commonly within the practice of governments. So short-term borrowing, we understand what that is. So what about now when we have the repayment of the short-term borrowing? So obviously, when we borrow funds, there's an element that's attached to it, right? With the cost of borrowing, which is what? Interest, right? So nothing's free in life. So we can't just go to a bank and say, "Hey, I'm gonna get this money, and I can just give you $250 back in a couple months, just straight up your $250." There's going to be an element of interest attached to it. So we need to know how to account for both the principal and the interest, right? When we make these payments. So it says here, repayment of principal of short-term obligations is not an expenditure, right? So we know the principal that we originally borrowed was $250,000, right? So that's not going to be recorded as an expenditure, right? But the associated interest is going to be recorded as an expenditure, right? So what's this repayment of a short-term tax anticipation note look like? So since the principal is not going to be recorded as an expenditure, we're just going to reduce that liability, right? Because we're just paying back the principal. So we're just going to reduce the liability by the exact amount in which we borrowed. So we can see here we're now debiting the tax anticipation note payable, right? Because we've eliminated that liability because we're paying the bank back. But then we've incurred interest at 6% for 3 months, right? But the interest, notice here, we did count that as an expenditure, right? And that's $3,750. And then obviously the cash payment of $253,750 is going to be the total payment. Why do you think we would treat interest as an expenditure and not the actual principal?
Well, I'm not sure how to word it, but I understand why the principal is money that you use, and then
That because we borrowed, right? That we borrowed, that we originally didn't include within the budget, right? We borrowed it, so we're borrowed it. So you're right. So we're not going to count that as an expenditure because we weren't really counting that in the beginning because we actually borrowed it. It's just a liability. It's short term, right? So we're just going to pay back the principal. But why would interest count as an expenditure but not principal? Because think about it. That's what it cost the government in order to obtain those funds, right? So that's why the principal is merely just going to be a wash, but the interest has to be counted as an expenditure because it actually went against that budget, right? So that way we have to actually count that as an expenditure because it did cost us $3,750 for the government to actually borrow that money. That was the cost of borrowing that 250. Make sense?
Yeah.
Okay, and now how would we calculate interest here? Because I know a lot of times students can have trouble calculating interest. How do we go about calculating 6%? How did they get 3,750 out of 250?
I think it's multiplying 250 by 6%, and then dividing it by 12 and multiplying it by 3.
Yeah, you're on the right track. And I think you said it right. It's just, let me make sure that you said it right. So what you're saying is we take the $250,000 and then we're going to multiply that by 0.06, right? And then we multiply that by 3 divided by 12, right? Because that's how long it was outstanding. Because we know interest rates are what? Per what?
Year.
Right. They're based on yearly states, right? Per annum. So obviously, if it's 6% for the year, then we have to know how long of a period of time it was actually held out there. So good job there. A lot of people forget to factor in the fraction of the amount of time. I just wanted to make sure you knew to include the fraction and not just 6% for that, and just make sure you know that that's 3 out of 12. So good job on that one. So we're good on the repayment and on the borrowing, right? So when we borrow short-term anticipation notes, where do we record it at? Is it going to be in the government-wide or within the actual governmental funds? For short-term, remember short-term, right?
Governmental.
Right, because it's current financial resource measurement focus, right? So we're going to record it within the actual governmental fund because we know we're going to pay it back within that current period. And we also know when we repay it, the principal, we just reduce it, we just debit it right back over with the principal that we borrowed, and then we have to incur an expenditure with the interest, right? So we're good on that. Okay, interfund transactions. Remember, we have interfund transfers, right? But now let's talk about interfund transactions. So these are transactions between funds, and they are of particular interest to financial statement preparers and users because failure to properly report these transactions is going to result in two funds being misstated. Obviously, if we're not dealing with interfund transactions, if we're not keeping up with that, then obviously the two funds that are participating in those transactions, if we're not accounting for them, then they're going to be misstated, obviously, right? The funds are going to be out of whack. So that's really important to people who are preparing the statements and the people that are using them or the readers of the statements, right? Additionally, since most of these transactions are eliminated in the government-wide statements, it is particularly important that they be identified in the accounts of the affected funds. So, in order to make sure that the government-wide statements are accurate, then we need to see this pattern, these entries being taken care of within the governmental funds, because ultimately, just like in your for-profit sector of accounting, intercompany transactions between a parent and a subsidiary have to be eliminated. Like any of the transactions have to be eliminated to get a true economic understanding of where they're at. So same thing here with interfund transactions. Just know they need to be accounted for and they need to be eliminated before government lots are prepared. So that's why it's of particular interest to both the preparers and the users. Make sense? So the types of interfund transactions. Interfund transactions may be interfund services, also known as quasi-external transactions, and these include both loans between funds and interfund services. Another type is going to be reimbursements, and then another type is going to be a transfer. So let's go ahead and get in a little bit into what each of these are. So interfund services, as I said before, they're sometimes called quasi-external transactions. And these are transactions which are typically sales of services between funds and are exchange-like transactions. So pretty much these interfund services right here, they're going to be treated like exchange-like transactions, meaning they're going to be treated just like you're used to seeing in your intermediate courses or your for-profit ones. Exchange, because those are exchange-like transactions. They're at arm's length, right? Meaning we're going to exchange something of equal value, right? So these are just like it. So they're going to be treated as a revenue and an expense or an expenditure of the affected funds, right? So a good example would be the sale of electricity by the Electricity Enterprise Fund to the general fund. And I know here you're probably thinking, well, I thought the enterprise fund was the service outside the government. It can also sell to within the government too, but the difference is it's usually on a for-profit basis. It can be for a cost recovery, but it's usually for-profit. Um, so just to keep that in mind, the enterprise funds do primarily service the sector outside of the government, but it also can service parts of the government as well, not just the internal service fund. So just keep that in mind. So like I said, a good example is a sale of electricity by the enterprise fund to the governmental fund, as if they are just not even related. As if you own a business, I own a business, and I'm going to sell you some electricity. No different. The only difference is the enterprise fund of the government is selling to the general fund of the government, right? So the sale would be treated as revenue for the enterprise fund, right? Because the enterprise fund is the one selling it, right? And it'd be an expenditure for the general fund, right? Because they're not expenses, but they're expenditures, right? Makes sense. The enterprise fund sold it, so they're going to count it as revenue. The general fund is receiving the electricity, so it's going to be an expenditure for them, right? Skip something. Okay. Okay, reimbursements. So this is going to happen when initially one fund pays a bill and then pays for a good or service for another fund is what it is. So they're going to pay for it. They might knowingly pay it, knowing that it's not their bill, and later on being reimbursed. And sometimes they might accidentally pay for more than what they should have, and then just set it up as a reimbursement later. So it says when the reimbursement is made, the expense or expenditure is recorded in the correct fund, and the initial incorrect expense or expenditure is reversed. So let's look at what that's going to look like journal entry wise. So assume the government receives a bill for janitorial services in the amount of $10,000, okay? And it is initially recorded in the general fund as follows. So we're going to have the expenditure, debit of expenditures of $10,000, right? And then credit accounts payable of $10,000 because we just received the bill, right? So we know they've already performed their services, so we owe them. So at this point we have a liability. That's why it's going to be an expenditure. So expenditures of $10,000, accounts payable $10,000, right? So now that's set up. We've set that up. We've incurred the expenditure and we've set up the liability. So later on down the road, we discover that 2,000 of these services were actually for the electricity enterprise fund, right, instead of for the general fund. So really, the general fund in this case has expended 2,000 more than what they should have, and the enterprise fund they're understated on their expenses because they haven't spent anything, right? So what do we need to do? So the entry for the general fund here, all we're going to do, since they paid it for the enterprise fund, they're going to say, okay, well, enterprise fund, you owe us this money, right? So we're going to debit due from electricity enterprise fund, right? Because why? Receivables is what?
Receivables
is considered to be what is it? It's an asset, right?
Right.
So that's why we're going to debit it, right? The due from. So we're going to, because remember, assets are original debit. So we're going to debit due from the electricity fund because they owe us that money that we paid, right? And then credit expenditures. Why did we credit expenditures?
To reverse 2,000 that we shouldn't have.
Right, to reduce the expenditures, right? Because the expenditures, just like remember, an expense is an original debit. So expenditure is an original debit. So if we're going to credit it, we just reduce that expenditure. So now we're back intact in the general fund, right? We paid it on accident. Now we're saying, hey, enterprise fund, you owe us this $2,000, so we've got to due from the enterprise fund, and we credited expenditures to relieve our expenditures. So now we're back intact. But the enterprise fund has to make an entry as well. Obviously, $2,000, they should have expensed that, right? And notice it's an expense because they're on the accrual method, right, of accounting. So they're going to incur an expense. We know expenses are original debits, right? So they're going to do a janitorial expense and then credit due to the general fund. So now they have a liability to the general fund, right? Makes sense? Not bad, right? And remember we said funds are their own, like a system, their own accounting. They have to balance a set of self-balancing counts. So that's why we have to do the due from and due to keep them intact. Because remember, you have to have a debit and a credit entry in each relative fund, right? Remember, do you recall that from what is a fund? So that's important when we do the to and to froms. But that makes sense, right? So the general fund got the bill at first. We debited the full amount of 10,000 expenditures, set up the liability. Later down the road, we found out the enterprise fund should have incurred that expense, not us. So we debited a due from the general fund or enterprise fund, credit expenditures that set it up as, hey, you owe us this money, reduced our expenditure. Enterprise fund incurred the expense instead of the due to. Not bad, right? Okay, now let's talk about transfers. And I know we talked about transfers a little bit already in this class, right? Because that's part of the other financing uses and other financing sources and stuff of that amount. So it says any assignment of resources from one fund to another where there is no expectation that the amounts will be repaid. So that's the difference between the transfer and that of the services or the reimbursements. The services obviously is an exchange-like transaction. It's going to be set up with someone recognizing revenue and expense and a payable and all that. Reimbursements, either a fund knowingly or unknowingly pays a bill for another fund and they want their money back, right? As we just showed. Transfers, they don't care. It's been appropriated and they budgeted it in that they're going to make these transfers, and they count that because we know when we set the budget, what's one of the entries we set on the budget? It's estimated revenues, estimated other financing sources, which we know is a transfer, right? So we've already accounted for. We know at the beginning of the period what transfers are going to take place, and we also know transfers are expected to be not reimbursed, right? We're just going to merely transfer that money and we're just giving it to the other fund in essence. So transfers into a fund are considered other financing sources, right? So if money's coming into a fund, it's an other financing source, right? If transfers out are considered other financing uses. So if we're pushing the money out, we're transferring out, we're using that money. So other financing uses. Recurring transfers, which is familiar or something we would see for going to the debt service fund. Recurring transfers there to pay off principal and interest are usually built into the general fund budget so that we account for all these transfers that are going to be coming up. So let's assume the general fund transfers $10,000 to a debt service fund. So the general fund entry is going to be other financing uses, transfers out, $10,000 will be our debit, and then cash $10,000, right? Not bad. And a good way to do this, if you get a little confused on the journal entry here on a transfer out, just know you know what half of the entry is. If you're in a general fund, you're trying to determine what the entry is going to be for a transfer out. Well, you know you're transferring cash out, so you know the credit's going to be cash, right? So therefore, if it's a transfer out, we know we have to account for it as other financing use. You know what I mean? Transfer out. So that tells us what the debit's going to be. If you really just stop and think about, okay, well, I'm transferring it out, I don't know the entry, but I know money's going out, so the credit has to be cash. And if it's a transfer, then it's going out, so it's got to be other financing uses transfer out. Bam, got my debit entry. Makes sense? So now the debt service fund would record the receipt. Obviously, same thing here. If the debt service fund is getting the transfer in, we know we got half the entry. We're going to debit cash because they're getting cash, right? But then, obviously, if they're getting the cash off a transfer, the credit has to be other financing sources transfers in for $10,000. Not bad, right? And main thing is, just with transfers, always remember that the funds are self-balancing and self-balancing equations in the accounts. So they have to have a debit and a credit. So you just have to make sure you're keeping up with the due tos, due froms, the transfers, the transfer sources in and out and stuff of that sort. Not bad, right? And like I said, if you ever get confused on what that entry is, just stop and think about what's going on, okay? If the transfer's coming in, okay, we're debiting cash because we're getting the cash, and then it's got to be a use, you know, or the other financing source, you know what I mean, transfer and stuff of that sort. We good on the different types of reimbursements, transfers, and the internal services, the different services, and how to account for them between funds. Not bad, right? Okay, special items. Special items are significant transactions that are either unusual or infrequent, but they're within the control of the management, okay? The example they give here is a sale of a capital asset. That's going to be considered the proceeds of the sale of capital asset is going to be designated as a special item. So that if you see a special item within one of these financial statements within the governmental fund financial statements, that we should know, okay, well, they've sold a fixed asset, right? So obviously, if we sell a capital asset, we obviously know we're going to sell it. In this case, we sell it for $77,000, right? So if we sold it, we know we're going to be receiving money. So we're getting a debit of cash, right, for $77,000, and then the credit will be the special item proceeds of sale of capital assets, right? Now, I know you're probably wondering, well, how are we removing that fixed asset off the books? Where's that entry at? Where's the entry for removing the fixed assets? This entry is good for special items within the governmental funds.
Right.
So where would we have to remove the fixed asset from? What financial statements are those? What entry would that be affected on?
Would be the government-wide,
Mm-hmm. Because why? Government-wide operate on what type of accounting?
long-term and
Accrual. Right. So that's the economic resource. They're concerned about everything: short-term, long-term, full-blown accrual. So yeah. So there would have to be an entry made on the government-wide to relieve, and then obviously that entry would deal with your depreciation and adjusting and getting your asset off the books, just like you would see when you sell a fixed asset from your intermediate course. And I'm sure y'all probably covered on how to remove an asset from the books. So I just want to point that out here. It's not anything that we're going to see yet. I just want to just point that out. Obviously, we've sold a capital asset, but the journal entry to remove the capital asset is not within governmental funds. This is the only entry we make. But the actual assets removed from the government-wide statements, so, which makes sense, right? Because we're only focused with what on governmental funds?
Sure.
Right, current financial resources, right? All right, the fund closing process. I know everyone has already went through, hopefully in an intermediate, the closing process with shutting down your books monthly, quarterly, yearly, or whatever they might be. So the closing process for government type funds need to accomplish the following. We want to close budgetary accounts. What are our budgetary accounts again?
Encumbrances.
Encumbrances is one of them. Yep. So we know the encumbrances account is encumbrances in the reserve for encumbrances. And now think of the budget itself. What accounts are in the budget?
Would transfers be part of that?
That's right. But what are they called? What account? What is the account called?
Financial sources and uses.
Right. What other part? What you're missing? Two budgetary accounts. What are the last two?
Revenues and expenditures.
Appropriations and estimated revenues.
Okay.
Right? Because remember, you set the budget. So when you think of budgetary accounts, try to think of a mental image of the budget, of how the budget sits. We know it's estimated revenues as a debit, estimated other financing sources as a debit, appropriations as a credit, estimated other financing uses as a credit. Budgetary fund balance is just a plug. So those are our budgetary accounts, right? Plus encumbrances. So those are the budgetary accounts. They need to be closed. Obviously, revenues, expenditures, encumbrances, and related financing sources and uses to fund balance. So obviously, the financing sources and uses, we just covered that. Those are budgetary accounts. And obviously, the operational ones. So we're used to seeing stuff like the revenues and expenses and stuff have to be closed because those are income statement accounts, right? So we need to close those and make them reflective onto the balance sheet, right? So that's on that. So let's take an example here. So closing the budget. So we know budgetary accounts need to be closed, right? So we have to therefore close the budget. That's the only way to accomplish it. So it says the budgetary accounts, considering any budgetary revisions, obviously, because the budget's going to be revised throughout the year. So by the end of the year, the revisions have already been made, right? They either have or haven't been. So considering any budget revisions, that's why it's saying that, are closed to budgetary fund balance. Remember, budgetary fund balance resembles what as in business sector or for-profit sector? When you close your income statement, where does net income close to for commercial businesses? It's a component of retained. It's a component of owner's equity. I about told you what it is.
Retained earnings.
Retained earnings, right? Because we know operational accounts, anything that whether it's a net operating loss or if it's net income, it's going to be closed to retained earnings. So it's either going to go up or reduce them, right? And retained earnings is a component of equity. Well, in governmental accounting, budgetary fund balance, if you recall from chapter 1 or 2, I don't remember which one it was, it says that the budgetary fund balance serves as retained earnings for governmental funds, right? Because obviously, if we're closing the budget to budgetary fund balance, then obviously it kind of resembles closing net income to retained earnings. So closing the budget to budgetary fund balance. What sticks out at you at this entry? So this entry closes the budget. What do you recall? What if the numbers are verbatim to another entry we've seen? An entry looks a lot alike. So what sticks out about this entry here?
Well, it's the reverse of a budget.
It's the same budget we set early, right?
Right.
So you're pretty familiar with the closing process. Then it's pretty much you just reversing whatever accounts are open, and then you close it to a certain account with the difference, right? So we know when we originally set this budget, if we recall, the original difference on budgetary fund balance was 550. These numbers are all verbatim, remember? It's because when we originally set the budget, these are our original debits up here, right? And then the appropriations and estimated other financing sources were credits, and then this was an original credit. Remember, it's the exact same entry, it's just everything is totally reversed. Because we know all these were credits last time, all these were debits. So that's how you close the budget. Pretty simple, right? Now, what about encumbrance accounts? We have to close encumbrance accounts at year end. Am I moving too fast for you? No. Okay. So closing encumbrance accounts. So encumbrance accounts are closed at year end and then reestablished in the next year. So let's just start at the first top here. So last day of the year, December 31st, year one, we're closing the books, right? And we know budgetary accounts have to be closed, and encumbrances are part of the budgetary accounts, so we know we have to enclose them. So let's say at the end of the year, the government has $500,000 encumbered. So what are we going to do? We're just going to unencumber them. Just exact same entry when you receive the goods or services, right? It's pretty simple, right? So we've unencumbered the funds. So whatever's unencumbered, we unencumber them at year end. In this case, it was $500,000. So January 1, year 2, now it's the very next day. What are we going to do? We're going to re-encumber them. So encumbrances, $500,000. Budgetary fund balance reserved for encumbrances, $500,000. To reestablish encumbrances at the beginning of year 2. Pretty easy, right? But that just keeps it intact. So that year for year, we know what's encumbered and what's not, right? So that's just the entry that has to be made. Pretty simple, right? No different than receiving the goods. The only difference is you just re-encumber it at the first day of the next year. So what about activity accounts? Activity accounts are also going to be closed to fund balance. So just remember, budgetary accounts and activity accounts all close to fund balance, right? Budgetary fund balance. So obviously we can see here with the numbers, we don't worry about where the numbers came from, but they're still building off of other slides we've previously seen. But same thing here. We're just going to completely reverse whatever these relative accounts are, right? Because we know revenues was originally credited when we were throughout the period that we operated, the operating period with net current year. All the entries with dealing with revenue was credited. The revenues were credited, right? Other financing sources, we know all those were original credit entries. Special item, remember we sold that capital asset for $77,000. We know that was a credit entry originally. Remember, because we got the cash as a debit, we credited the special item. Expenditures, we know we originally debited expenditures. Other financing uses, we know we usually debit those. So therefore, we just do the complete opposite. If it's a credit, we debit it. If it's a debit, we credit it. And then we plug the difference in the fund balance. In this case, it's a credit. Pretty simple, right? Closing process, I think a lot of people make it a lot more difficult than what it really is. I mean, you have to understand the process of it, but really you're just reversing it and then plugging the difference, really. It's just you got to know what accounts are relative, right? Not bad.
Yeah.
So what do we have to close? What accounts do we have to close at year end?
We have to close all budgetary accounts.
Right.
And then the activity accounts.
Right. Yep. That's it. And obviously, the fund balance, obviously we know we were just closing at the fund balance. From that point, the fund balance is presented within the 5 categories of fund balance, right? And we know it's either non-spendable or spendable. And then the 4 spendable is restricted, committed, assigned, and unassigned. And we know that unassigned is a general fund residual. right? We also obviously we went through these in detail in chapter 3. Um, what constraints? Who puts constraints on non-spendable funds?
That would be like very high level of authority. Um, so like the higher government.
Think if it's non-spendable, it's going to be people outside. So
Oh,
it's going to
okay.
be debt covenants, like people who donors and who stipulate what the funds can be. And what's another thing that's non-spendable within the government funds, but it's reported different on government wide. Remember, there's a certain fund that the corpus is permanent, the permanent fund. Remember, that corpus is not spendable too. So the corpus and then stuff from outside. And the only reason I'm doing this is just a quick review because this is old material now. So we know if it's non-spendable, someone outside the government placed those restrictions, right? Because obviously the permanent fund is built from people, from donors and stuff, and people stipulating stuff like doing endowments and stuff within those funds. So the non-spendable, it's an outside restraint. The restricted, now we're to the spendable. The restricted is going to be somebody from someone from within the government at the highest level, right? Um, then and the restricted could also come in the form of hold on, I'm telling you wrong. Let me back up. No wonder you're confused. Non-spendable is going to be your supplies. I forgot the whole thing. Your supplies and your prepaids in the corpus, right? I'm sorry. I remember that. Remember when we were building and dropping them down? So I apologize to everyone. I got a little confused there. I forgot a whole category. So non-spendable is your supplies inventory and your prepaid expenses. Remember how we just drug those down when we were building those categories of spendable and non-spendable, and then the corpus. Then the restricted is from outside, right? From the outside bodies of what I just explained. So I apologize on that. The non-spendable is your prepaids and your inventories and your corpus of your permanent fund. Your restricted is placed by people outside of the government, from donors and bond covenants, stuff of that source. And then the committed is what you were talking about, from the highest level within the government, committed those funds, right? A good example of committed funds, recall, is like contracts for construction contracts and stuff like that. Assigned, they merely have an intent. They've stated an intent, and as we know, like encumbrances, so they've had the intent to buy supplies and stuff. So we know encumbrances, anything encumbered goes to assigned, and then unassigned obviously is just a residual, the leftover. Sorry about that. I was trying to help out and I confused more than I helped out. So I apologize about that. Um, so that gets us through this chapter here. Let's just see here. Is there anything in this chapter that we covered that was of any particular difficulty that you have any questions on that you want to go over? Because that's all I have for today. So we're finished a little early today.
I think I'm good.
You think you're all right?
Yeah.
Okay, and like I said, Friday my plans are just to I want to hang out in this chapter a little longer. So just to give you an idea of what we're going to be doing Friday, there's just some good practice on just some illustrative case for the general fund and this special revenue fund within the book. I don't know if you've actually read the chapter. If you haven't, I suggest to read it. It's a really good chapter. It really breaks it down with the different entries. But if you don't, like I said, we'll be playing around with it some. We'll read through some of the scenarios and I'll put up the different journal entries just to get a little more practice with it in here. And we might get out a little early on Friday as well. We'll just see how Friday plays out. But like I said, that's all the content for chapter 4, and we'll just be doing a little bit of some illustrated examples of some entries we'd expect to see in both the general fund and special revenue fund on Friday. Once again, just I thank you for your time, and just remember, if you have any questions or concerns with anything, just let me know. I did get the other homework graded. I don't know if anyone's looked at that. So the other chapter, I think chapter 2, I believe. Chapter 3 is due this Sunday, right?
Right.
Because there's a lot. We're covering content a little quicker than the assignments do. I like covering it and then leaving like a week to allow y'all to work on it. But so yeah, chapter 3 this week. I just said chapter 3 is this week. It's due, and like I said, chapter 2, those grades are in. So just check those out. And then, like I said, Friday we'll be reviewing some more entries and stuff, and just remember to get your stuff in on Connect by Sunday at 11:59 p.m. And that's all I have for everyone today. I appreciate everyone's time, and we will continue on with doing some examples from Chapter 4 on Friday. Everyone have a good day.